to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode features a different topic and a guest who shares their experience and knowledge with us. Tune in and learn something new with BankTalk podcast.
Hi, and welcome to BankTalk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we're going to talk about liquidity and the balance sheet. Recently, we asked our listeners, hey, what do you want to hear more about? And three topics came up. One of them was, give us a better understanding of fraud and what's going on in that space. One was, let's spend a little bit more time in data analytics. So, a little bit maybe better understanding and know your customer. And then the third one was, let's spend some time around the balance sheet. And we've had some episodes in the past, but maybe a little more in depth because there's so much going on with liquidity and investments and everything else that it's important to continue to cover this topic. So today I have with me a couple of folks from the Darling Consulting Group. And we're going to have a conversation around just the balance sheet and maybe some ideas they might have to help you improve yours. So without further ado, let's get to Bank Talk. Okay, welcome back to Bank Talk. Today I have Zach Zoya and Vin Clevenger, Managing Directors at the Darling Consulting Group. Zach, Vinny, thanks for joining us.
Thanks, Charlie.
Charlie, thanks for having us. Appreciate it.
As far as interesting guests go, I spent a little bit of time listening to the fact that you guys have a podcast. It's called On the Balance Sheet. Zach, are you okay just giving us a second on more or less what does the Darling Group do? And then, maybe just a bit on the On the Balance Sheet podcast and some thoughts there.
Charlie, absolutely. It's our pleasure, being here with you. We listen to your podcast too. You do a terrific job with this. So we're honored to be here. And Darling Consulting Group, we work with banks and credit unions throughout the country as an advisor partner, really on the strategic side, helping them manage their liquidity, their rate risk, their capital. We've been around, Vin, for over 30 years. We work throughout the country, big banks, small banks, all throughout. And podcast idea was a couple of years ago. Vin and I kind of came up with it, and it was to highlight our clients, right? And there's a lot of great bankers out there, some in places you never heard of. And we just kind of wanted to give them a spotlight to tell their stories and talk about their bank, their town, their communities. So a lot of it is just featuring, CEOs, CFOs of our clients and letting them talk. And the feedback we get, Charlie, I'm sure you get plenty with your podcast, is people like to hear what other people are doing who are like them. So the bankers especially, they're always asking, hey, what are other folks doing? And we found it's been a pretty good format for that. It's been a lot of fun, too. We think we're getting slightly better as we go along.
Yeah, that's great. And there's so many interesting stories out there, right? If you could find a way to ask the right questions, I think the stories are phenomenal. Some of these things are family operated. Some of them were handed down over the years. Some of them were acquired. I mean, there's just an unlimited number of stories, and I think most of those just kind of rotate around. Typically, there's always a character involved as well. So I think that's always fascinating. Okay, so today I thought what we would do is spend a little bit of time around your area of expertise. And Vinny, I was hoping that we could start with the yield curve and just what's going on there in the past 6 or 8 months. I keep hearing inverted yield curve, and not being an investment expert, I struggle with that term a little bit. Could you give us just a couple of minutes on what that it looks like these days?
Yeah, no, and thanks again, Charlie, for having us. Absolutely, and that yield curve inversion, I think you had noted 6 to 8 months. It's been going on for almost 3 times as long, depending upon which way you look at it. But simplistically, for those uninitiated, when you are looking at the yield curve, if you hear that vernacular, what they're really referring to is the dispersion of different yields you can get if you were to invest in the Treasury. So if I'm an investor and I want to buy debt issued by the Treasury, there are different terms upon which I can invest and place my money into that instrument. You'll have short-term treasuries. Those are commonly referred to as bills. There's intermediate-term treasuries. Those are called notes. And then, of course, you've got bonds. Those are the longer dated maturities. So you've got this wide dispersion of instruments where you can, as an investor, and place your money into and get a different rate of return. Now, historically, you would get a better rate of return on a longer dated bond or note than you would if you were to buy a shorter term investment, a shorter term treasury bill, say a 3-month. You'd always get a better yield on the 10-year treasury. And the 10-year treasury is so important. It's kind of like the bellwether when people are talking about the yield curve, when they're sort of trying to figure out what borrowing rates are at. And you'll see it. You'll see the 10-year treasury. It's on the screen all the time on CNBC or Bloomberg, or maybe even your local news if they do an overview of the markets on that particular day, always highlighting the 10-year treasury. But we've now been in a inverted yield curve environment where if me as an investor wanted to purchase a 10-year treasury, I get a yield of 4% today, in and around 4%. Whereas if I just put it into a 3-month treasury bill, I would get 5.30, 5.40, 5 something, a rate that's much higher than the longer term treasury note. And that's really quite interesting because, and this is really intuitive, if I'm going to give the government my money and I don't have access to the liquidity for 10 years, I would expect a better rate of return on the longer bond than the shorter bond. But clearly that's not going on right now. And that's not going on because the Federal Reserve has raised interest rates significantly all the way up it's really between 5.25 and 5.50. And the short end of the yield curve reacts sort of, right with it in lockstep. There's always been a rule of thumb. The Fed kind of controls the short end of the yield curve. The markets control the long end of it. And that's not necessarily true as it used to be. There are different mechanisms by which the Fed is manipulating the term structure, the longer rates. But all that together, you have an inverted yield curve. Why is this important? If you look at the 3-month treasury versus the 10-year treasury, the last 8 times it's been inverted, it has preceded a recession. Now, some folks look at the 2-year treasury versus the 10-year treasury, and that's been inverted for, I think, Zach, going on 18 months now. It sometimes can signify a recession. And so there's plenty of people out there saying, well, look, this might be on the other side of it. But the bottom line is, in the business of banking and how we look at it, it's a difficult time. Banks take in their deposits, and they're correlated to the short end of the yield curve by and large. And all of their assets are basically pegged to the intermediate and longer term points on the yield curve. So said differently, they're taking in deposits at, call it 5.5, and they're writing loans not much above that. So in an industry, particularly community banking, the credit union space, that so much of their bottom line is determined by the spread between short treasury rates and longer treasury rates, it's upside down right now. And it has been so for a long time. So I was hoping that wasn't too long-winded for you, Charlie, but I'm hoping that's a very high level sort of overview of what's going on with market interest rates.
We'll be right back.
If you're dealing with a technology vendor, consider giving Remedy Consulting a call. At Remedy, we're dedicated to helping our clients get the most out of their tech spend. If you're considering changing one of your major tech providers or are renewing a contract with a vendor, the Remedy team may be able to add some value. Our clients enjoy our deep experience working inside these major vendors, and that background helps us ask questions which eliminate headaches and expense for our clients. Sometimes that's immediate relief, in the way of your vendor invoices, and sometimes that comes in the form of contract language protection for a strategic move that you may want to make several years later. The group of experts at Remedy have years of experience in core systems, digital, mobile, payments, item capture, commercial banking, pretty much the whole gamut of technology for financial institutions. Remedy approaches the BankTalk podcast the same way we approach our client engagements. We always try to fill some knowledge gaps, but also just have enough life experience stories to remain entertaining. So if you're renewing a technology contract or you have projects going on, just need another opinion or a project manager from outside your organization, reach out to us at remedyconsult.net. Thank you, and we appreciate you downloading the Bank Talk podcast. Now let's get back to our episode. No, I think that's great. I think you did a great job with it because there's a lot there, right? There's a lot to unpack. My first question was going to be how long? I think you answered that. It's been some time, 18 months. Did I get that right?
That's if you're looking at the inversion between the 2-year Treasury and the 10-year Treasury. Now, the 3-month Treasury, it hasn't been as inverted for as long, I should say, because the Fed had to actually move rates up to get short rates to move with it. But it's right behind it. There's a little lag there.
Okay. Yeah. And I don't know that the time is as important as the way I would. So my next question would be, so you have this decision to be made as sort of a chief investment officer. And again, maybe it's across the bank. And that I think the decision is always, how do I get more deposits? Obviously, and we'll talk about that in a minute. But the other question I have is, how do you lend in an area like this? So I think of a commercial loan, and I think of a commercial loan portfolio more specifically for a bank, and sitting there and saying, okay, I've got some loans that I've made in the past, and I've got some loans I need to make in the future. And with this uncertainty, how do I determine what price I'm putting on them? So do you have any thoughts on, is this going to affect lending and, by that nature, maybe stifle the economy there, right? I mean, how do you think about lending, or how do you make that lending decision if you're a banker?
Well, for a variety of reasons, we're already seeing that to a degree, and to varying degrees in different geographies, and it depends on kind of what your core business is as an institution. But yes, that is the case. And that's the case because what happens is with certain projects, if the rate that customer is going to get charged, and let's just say they've got tenants in a building, there's something known as a debt service coverage ratio where that property has to spit off enough income to support the interest payments on the loan that you're going to give that customer. If that gets to a place where people are no longer in that building, think a office building or think of any other sort of building where people are working from home and they don't need that space anymore, you get to a place where the loan won't work financially. The income produced by that property does not support the debt on it. And so you're already seeing the influence of higher interest rates across the industry slow that to a degree in different parts of the economy. However, there are still loans to be made, and talking about how do you price them, boy, it's tricky. It's tricky, and banks and credit unions have different philosophies on how they should price them. But one major consideration, and I'm sure Zach will probably touch on this as we move forward, is what does it cost your institution incrementally to fund each dollar of loan growth? Because in reality, if I kept getting core deposits or DDA at, let's just say I'm getting in interest-free accounts, well, then it probably doesn't matter what I charge on the loan, right? But that's not the case really anywhere in the country. Quite frankly, it's the opposite, whereby every penny that's coming in is at a rate of 4.75 or 5% or 5.25 or 5.5. And then I have to figure out how to price a loan over and above that. And that's really the way banks should be kind of focused on pricing their loans. What it costs you incrementally at the margin to fund new growth.
Right. So let me ask another question related to loans, and I think of a commercial loan as a balloon loan, right? And a balloon loan being, look, Vinny, I'm going to lend you on that building. And that loan is maybe have a 30-year amortization, but it can either have a fixed or a variable rate up front. And the balloon period could be 2 years, 5 years, 1 year, technically, right? Is the way that lending is occurring to deal with this yield curve, is there any change in the way some of those loans are going out from a commercial perspective? As it really, because there is a little bit of flexibility in how you price your loans as well, right? So Let me stop there, and I don't know if that's you or Zach that might answer that, but you have any thoughts on that?
Yeah, I think what you're saying is are we seeing changes in the structures of these deals, from what we've become accustomed to? And I can't speak for every single institution, not as much as you would think. And the other part of that is, banks also embed prepayment penalties in their loans. So obviously you'll hear plenty of people saying, or even like if you think of the residential markets, which we've seen incredible appreciation, but you'll hear people, the odd person buying a house here or there say, well, yeah, we got a 7.5 mortgage now, but rates will go down or we'll refi. Well, on the resi side, that's not a problem. On the commercial side, you can't just refi out of a loan if it's got a prepayment penalty in it. So a lot of these banks and credit unions, more banks so, are protecting themselves against downside risk of rates dropping off a cliff again with these prepayment penalties, as they should be. They're lending in an environment when really probably no one else was giving you that money. But in terms of the terms of them, you may see some deals like here and there, and Zach, feel free to augment my remarks, is like maybe now folks understand that the math isn't working on the property anymore, and they're moving the deals to interest only for a period of time, and then they're waiting for rates to come back down, and then they'll go back to principal and interest. So there's can be some of that going on. I mean, you don't have to look too far back to see how that ends historically. But Zach, I'm not sure. You might see something, or something hasn't come to mind for me.
Yeah, no, I think it's a really good way to frame it, Vin and Charlie. And I think the bottom line is inversions make pricing a lot harder. Charlie, to your point, and growth is slowing, profitability is certainly being challenged by that. And I think what's interesting is you might think that if you're a borrower, I want a little shorter term deal, to your point, Charlie, because hey, if rates are going to fall and this curve is saying that that's what's likely, it makes sense. But the interesting thing is that it costs more money to do a short term loan because the curve is inverted. So it's we're not seeing a lot of change. Like at the margins, you see some of it, but I think a lot of people commercial is still your 5-year balloons or 5-year longer term AM type of deals. And to Vin's point, I think what bankers are trying to make sure they do is say, okay, let's protect ourselves. Let's make sure if we have prepayment penalties or we have floors or we have things that we can price to make sure that we're not the ones taking all of the risk, right? In this scenario.
Yeah, and that's a good point, right? So between prepayment penalties, floors, and the structure, they have a lot of tools, but it does get as some combination of chief lending officer and chief investment officer, right? There's probably some pretty interesting conversations around what the number becomes today when Vinny shows up for his next loan.
Well, if Vinny shows up, it's a much higher rate. Certainly going there, but Charlie, you nailed it. It all comes back to the asset liability committee, right? It's the ALCO, which is for those listeners who aren't maybe bankers, it's the folks who are helping devise strategy and manage the risk. And it's usually a CEO, CFO, your retail folks, your commercial folks, lenders, depositors. It's everybody who is seeing what's going on, and you bring them together, and so you're not siloed, right? So it's not one person making a choice, and that's one of those areas where we think it's so critical for bankers to make sure they're taking that seriously.
Well, so I want to jump into deposits a little bit because I think that's the other leg of the stool for the most part, right? The first question that comes to mind is, okay, so if I just take a deposit and I don't declare what type of deposit that is, right? There's some logic that says if you pay the highest rates on your accounts and your CDs, right, you'd both attract new depositors and also, kind of not have higher than average runoff from your current customers. I don't know that that's accurate. That's just my theory. Is there anything to correlate highest rate to least losses or highest gain on new customers?
Yeah, no, it's totally reasonable, Charlie, and it makes sense. And we have a lot of data that can show correlation to, if you're paying higher rates on certain accounts, a lot of folks may have a higher retention, or maybe they'll bring in more new money, depending on the time in the cycle. But I think the biggest thing Vin and I would talk to folks about, and what our banks are looking at is, but what's the cost? Like, what's the real cost, right? Because if it's just new money, right, then that's one cost. But if you have folks you're paying 2% right now, and then you're going to offer a 5% CD, and then they all decide to take you up on that, that's a different cost, right? You're repricing up folks who are already on your balance sheet. And by the way, those folks were we'll call it the raw materials to help fund those loans you already put on 2-3 years ago. Those 5-year balloons are being funded by the 2% CDs, right? And now those 2% CDs become 5, but the loans are only at 4%. So that's what Vin was saying, is that now you're upside down to a degree. So I think it's what a lot of banks are trying to do is not price up everybody. It's not because they're mean. It's because the math doesn't work. If you want low loan rates as consumers, it's very hard to have high deposit rates at all times.
Okay. No,
well.
that's a great perspective. And just as a little bit of follow-up to that. So there must be a balance between, obviously, I'm guessing there's a very high correlation between if I put the highest rates out there and advertise it, I'm going to get new money in the door. It might be money that leaves, right? If I've got the highest CD rate to gather deposits, I know that those CDs are probably safe. The next one, I have no idea, right? Will they renew it? All that kind of stuff. But then I would imagine that there's this dynamic around your customers either seeing your rate or seeing somebody else's and saying, should I be shifting cash around from this, DDA account where I keep my working capital? Should I be shuffling that into something that, do I need 100% of that? Or can I move some of that into somebody else's CD because I'm basically making zero on the DDA, on the deposit account, the straight deposit account. Should I lock it up for a while and try to grab a higher number?
Yeah, and
talk to me about that balance that your bankers are seeing between those two dynamics of not wanting to pay your current customers, right, and yet bring in new customers with a higher rate. There's got to be some conflict there, right?
It's been the biggest conflict, Charlie, overall, and I think what you're referring to is the marginal cost of funds, which is really the silent killer. It's the conversion, right? It's folks who are already with you. You've already earned their trust, or that they like working with you, and then they move money from a zero balance DDA or checking to a 4% or 5% CD or money market, and that cost just goes much higher, right? And you don't get any new money in a lot of cases. So I think a lot of the challenge is getting banks or credit unions to say, okay, which of our customers, what's their discretionary money and what is their operating money? What I mean by that is, what money do they have to have in DDA, in checking, to make payroll, to write their checks, make their bill payments, all those type of things? And then what's above that? And if we can get a better understanding as bankers of our customers, saying, okay, we know what's more core operating versus what's, hey, maybe this money's a little extra than what they need, so it could be at risk of leaving. That can help us formulate strategies. Say, okay, here's what we're going to do. We're going to have this money market account, and we're going to target this certain segment of our deposit base, and they can move over. We're going to, or if we're going to come up with a CD, let's understand how much of this deposit base could move into that, because we want to make sure we factor that in. Because if we have a huge number of folks who might, if they see the shiny 5% yield, move over, and we can't get a lot of new money out of the deal, it may not be worth it from the banker's perspective to offer something like that in certain times, even though maybe the retail folks would like to see that because it brings in, it might look good from the marketing side. But I think from a strategic side, we have to really bifurcate what's operating, what's discretionary, and be very targeted in our approaches, because throwing out a 5% on the highway, on the billboard, could be very costly. Very, very costly, depending on how many of your current customers move those funds over. And data is a big key in understanding that.
So now I have a sensitive question for you. And again, I'm not asking you to answer this as a customer, but at one point I sat around a group of CEOs at an event, and they were standing in the corner, conversation dropped off. So I asked a question, and my question was this: like, are you having strategic conversations with your customers just around what we just talked about, which is, Vinny, I know I can't pay as much on the deposits. I hope that, the relationship has been here for a while and you know why. However, right, maybe we should talk about how much money is in account A versus account B, and whether or not you should consider shifting some over into this money market fund we have here, or CD or whatever, into another product. And it looked like I had just dropped it was a very quiet conversation to start, and then it became a very interesting one. This consensus seemed to be, don't tell your customers, right? Don't have that conversation because it's too scary. And if all of a sudden they say, why aren't you giving me 3% on my deposits? I don't know how to answer it, and I don't think they'll understand.
Yeah, Charlie, one thing I'll just brings to mind is these are the type of conversations that were really going on right around this time last year, Zach, if you recall, because rates had really started to cook. And through 2022, when the Fed started its tightening cycle, and again, for the uninitiated, Fed started raising interest rates, most banks did not, and credit unions did not have to really pay anything on their deposits. And then all of a sudden, Q1 of 23 hit, Silicon Valley Bank thing hit, people started to wake up a little bit. And the question was, are we better off not saying anything and seeing how our deposit base reacts? Or should we kind of reach out to our best customers and tell them, hey, we can give you 3, we can't give you 450. And banks played that game through really the lion's share of last year. Now, as we got into the fourth quarter, believe it or not, rates have kind of almost reached their plateau. And in fact, when the Fed reaches the height of its tightening cycle, that's right behind it are the height of funding costs for financial institutions. So it's almost like that conversation is kind of in the rearview mirror. But one thing I will say, Charlie, the proof is in the pudding. If you look at bank borrowings in terms of their utilization of, say, the Federal Home Loan Bank, which is a banker's bank, if you will, and or look at banks and how they are starting and have really utilized that Bank Term Funding Program, which was a program by the Federal Reserve that came out in the wake of the Silicon Valley Bank sort of failure. Banks are borrowing. So that tells you if you've got some folks who are sleepier and they haven't moved their money yet, most of them already have, but those who haven't, let them sleep. And so it's like, to me, anecdotally, I've heard a lot of different strategies by bankers, but they've certainly resorted to borrowing to fill the sort of the shortfall of deposits that have left since this started.
No, that's a great perspective, because because the argument would be, if you start paying too much on those deposits, right? The scare seems to be, well, that might put me out of business, right? Like I can't necessarily pay on those deposits. And I always thought, though, as a customer of a bank, I would have appreciated the conversation. And again, as a customer, the first word is going to be, yeah, I would like more, right? But I don't know that I need more. You know what I mean? Like as a deposit holder, if you would come to me with a logical argument, and it's a scary argument as a banker, with a logical argument that says, look, you're a good customer, we appreciate having you around, this is how we're going to treat this, and we hope that it's good enough for you to stay around, I think I'd be with that bank forever, right? Or that loan officer, whoever my client partner is. But I think that it's such a scary conversation that, let sleeping dogs lie is probably the answer that most of them have took. And again, yeah. Vinny, to your point, this could be a year-old conversation, but I think it's still relevant as things start moving around. Like, some understanding of your more important customers, at least explain to them what your business line is and, how you make your money and all that kind of stuff. I do think they'd appreciate it.
Yes. And that's certainly, that type of strategy, I'm sure, engenders loyalty to the institution. There's no doubt about that. And I'd be surprised if through the course of Q2, 3, and I guess for some in Q4 of last year, they didn't have a list of their top 20, 30, 40 depositors, and those conversations took place. It's just for the rest of, their customer base, general population, if you will, those conversations didn't take place.
Well, maybe they don't feel stable, right? And
you do need to put a little framework around the relationship. You're not going to go have that conversation with somebody who just has 4, big CDs with you and they do no other business. They're sorry, you're renting their money. That's effectively what's happening. Yep. And so those conversations didn't take place. But Zach, how many large deposit lists came up in our meetings and people are like, we got to talk to this person, that person, that person. I can think of that going on through the course of last year with great regularity.
Yeah, Vin, absolutely. I think, Charlie, that's the kind of the crux of it is there are limitations, to how many folks you could probably reach out to and talk to. But the top depositor list, a lot of banks have concentrations, right? They have a smaller number of depositors who might comprise a lot higher balance, right? So I think it's making sure that we're understanding them from a liquidity standpoint. I think a lot of this today has been talking about price, which is important, but it comes back to what I think you both have alluded to, and Charlie, your example, where it's the relationship and it's service. And I may not need the highest rate if I'm happy with my bank. They give me what I need, and especially as a business customer, if I'm talking to them frequently, I may not need 540 on a money market. Maybe I'm okay at 5 or 475. And I think wrapping in the relationship and the service is incredibly paramount too, because if everybody just competed on price, it would just erode every dollar profit, out of the spread industry. So you got to differentiate certainly in a different way.
Yeah. Well, guys, this has been great. I've got one more question for you, Zach. So I wanted to talk about liquidity, and specifically in my head, I think of liquidity as there's probably a cheap end of the spectrum and then a high end of the spectrum. And the two that come to my mind are, that DDA we talked about, and then maybe a CD at 5.25% or whatever it is these days, right? There's that sort of cost of funds, and I'm sure I'm using the term wrong. Can you tell me, now that's a very simple person's version, and that is only deposits from my current customers. What other places are banks reaching out to today for liquidity when those two run out? Or can you give me a feel for, sort of the scale from top to bottom of what costs are as you look to different avenues to improve liquidity?
Yeah, Charlie, absolutely. I think that's a nice way to put a bow on the discussion, because he talked a lot about loan pricing and deposits, but it's how we funding the balance sheet, and all these things talk to each other. And I think if any banker has the choice, we'll take the cheapest cost of funds versus the most expensive. I think that's where, depending on the time, the yield curve, your growth and your balance sheets, we want to have everything available to us. And what I mean by that is, yes, like you said, you have your checking offerings and money markets, CDs. You have everything you think are reasonable to help your customer base, but there's a whole other world of, we'll call it non-customer, which we're talking about the Federal Home Loan Bank, the Federal Reserve, borrowings that banks can utilize, or we'll call them broker deposits, which are really non-customer deposits. And I think anyone who has a comprehensive liquidity plan has those facilities available. Doesn't mean they're always using them, but there are certainly times when it is cheaper to use wholesale funds than it is to, go bring in a retail CD. By the way, that time could be now, when folks are still above 5%, maybe for a 1-year CD out there on specials, and you can borrow from the home loan bank below 5%, right? And there are other times when it's cheaper to go to the retail base and go to your customers to try to generate more money, and the wholesale is a little more costly. So I think it's a give and take, but there are certainly times when you want to have all these available so that you can be efficient with the raw materials that you're bringing on the balance sheet, we'll call it, to fund your loans, to fund your investments. Because as Vin mentioned earlier, it matters what you're paying for your cost of funds, right? It does indicate what you can do to a degree on the asset front, right, overall. And there are limits, right? There are certain limits to what you can do on that. And I think a lot of that comes back to regulatory policies, things like that. The home loan bank won't just give you carte blanche, neither will the Fed. So the whole balance sheet has to be considered. But I think overall, liquidity is the most important thing. I mean, Vin, what are you seeing now on that front? I mean, I feel like it's a highlight. And did I miss anything? Kind of just wrapping that up.
Yeah, it's interesting when you look around the country and you speak with folks, and we are privy to kind of what the outcomes of their examinations have been through the course of the last several quarters, and it's clearly front and center in the regulatory world, as it kind of should be, right? You go back and look in 2023, and we saw a mass exodus of deposits leave the banking system, and the same thing held true in the credit union space as well. So examiners are. And even more recently, you've seen sort of a movement afoot to make the Federal Reserve and kind of pull the stigma off of the Federal Reserve as a lender of last resort, and really include the Federal Reserve as a place that you could potentially get some raw materials to fund your balance sheet. And you have to have a full complement of different places where you can take some of the collateral you already have on your balance sheet and utilize that to potentially fund your balance sheet with non-retail, non-traditional types of borrowings. And clearly that's been the movement afoot here through the course of the last several quarters as deposits have left. But it has been, you hit the nail on the head, Zach. If you're a management team, you have to be fully aware of all the costs associated with each resource to fund your business. And that's why banks and credit unions have turned to places like the Home Loan Bank, because at the margin, borrowing there is cheaper than repricing up a bunch of sleepier deposits up to 5%. It's extraordinarily cheaper. And so it's been a wild ride here, 2023, and we're not through it. We talked a little bit about the inverted yield curve to start this. And the longer we stay in this, the bumpier this ride gets. Hopefully we're closer to the end. That's like saying the sky is blue. But market interest rates have really thrown financial institutions for a loop here over the course of the past several quarters.
That sounds complicated. It's not that job used to be easier.
That's true.
Probably. Well, thanks, guys. I really appreciate you spending some time with us on Bank Talk today. Zach, Vinny, thanks for joining us.
Thanks for having us, Charlie.
Thanks, Charlie. Our pleasure.
So for Bank Talk, this is Charlie Kelly, your host. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast brought to you by Remedy Consulting. You can go to darlingconsulting.com or Zach's email is zzOIA@darlingconsulting.com. And also be sure to check out On the Balance Sheet podcast, and we will link that in the show notes. Thanks again, and we will see you in the next episode.